let's chat a little bit more about what investing in emerging markets right now is looking like with Daniel Needham. He's the Chief Investment Officer at Morningstar Investment Management, and he's joining in here on the show for a quick chat. Daniel, thank you so much for taking time out for us. What is your emerging markets call right now? Because the fact is that in the last year or so, things have, really looked up. Emerging markets like India, for example, have rallied up quite a bit.
Sure. So as long-term value investors, we're looking at what we think markets are worth relative to their long-term fundamentals. And so when we were looking at emerging markets back in 2014 and early 2015, they started to become relatively unpopular. Prices were falling, and there seemed to be some reasonably well-justified fundamental concerns that investors had. But as we looked at the market more and more, and we saw the price falls and we saw declines in currencies, we recognized that there was an opportunity that was opening up. And so we started to position ourselves in 2015, and then as 2015 sort of concluded, we entered 2016, we really started to increase that exposure. So by the end of Q1 2016, we had a relatively large exposure in the portfolio, and we'd been reducing exposure to some of the more overpriced parts of the market. And obviously prices started to move up more aggressively in 2016, and by that point we'd started to sort of slowly reduce some of our exposure as prices moved relatively rapidly within emerging markets.
Daniel, you do visit India once in a while, and you look at India as a part of the overall emerging market which you analyze. How do you see comparatively right now India placed versus other emerging markets?
Yeah, well, look, I should always caveat that I'm not from India, and so people here know the markets a lot better than I do, but I can certainly provide that, the global perspective. And so, Indian equities right now, if I look across the top sort of 20, 25 emerging markets that are made up of, say, the MSCI Emerging Market Index, India's sitting, around the middle across the opportunity set there. So we sort of think that over the next, say, 10 years, you're going to do better than US equity markets by a couple of percentage points. But when we look within emerging markets, emerging Europe, areas like that are on the more attractive side. So India doesn't really stand out as a significant relative opportunity inside emerging markets, but still versus, say, US stocks, it looks relatively attractive. Bonds, the bond market within India is actually at the upper end of our opportunity set. So when we look at the emerging market government bonds around the world, India's up towards the top end, and so we don't think that Indian bond yields are super attractive relative to history, but they're around fair value. So we think if you invest in Indian government bonds, you're going to get paid a fair return, which in an environment where cash rates are zero in the US and on the negative side in Europe is actually pretty attractive for a global investor.
If one were to analyze the Indian markets, they are a mix of the top tier companies, which are large liquid names where activity of foreigners is high, and then there's a small to mid area where lately the interest is very high and some are calling it frothy. How are you analyzing this, the two different opportunities to invest here in India?
Yeah, I think the Indian market, as you point out, is a very bifurcated market. You've got the large cap, sort of mega cap part of the market, which are really globally high quality businesses that have well-established economic competitive advantages and have generated high returns historically. And so, and then obviously the mid-small cap are more domestically oriented cyclical businesses and really diverse mix of companies. But when we analyse those companies, we see generally lower quality businesses with generally less weaker competitive advantages. And so there's been a large amount of capital that's flowed into these mid and small parts of the market, certainly on the back of stronger stock market performance, stronger Indian stock market performance. So we would say that on a relative valuation basis that mid and small cap stocks look less attractive than the larger part of the market, and as you suggest, things maybe have been a bit frothy as more and more money has flowed into the mutual funds, and mutual fund managers need to find opportunities, and so we're tending to see some money push out of the large caps into the mid and small, and that's seems to be pushing the valuations up. So, I think as we look at the market, we think on a relative basis, the larger, sort of safer part of the market, looks more attractive. And what we tend to see is that when the markets sell off, so, normally on the back of a decline in corporate earnings, it's the small mid part of the market that tends to sell off relatively heavily. And so, there's normally opportunities to reinvest, sell some of your large cap exposure to buy some mid and small exposure when prices are more attractive on a valuation basis.
Daniel, you were talking about how India has a capability to outperform US in the next 10 years or so. But from, say, a 2 to 5 year perspective, what would you say is the way foreign investors are looking at India right now? Is there an increased participation that we can expect, for example, in the coming years?
I think that generally the consensus is that India continues to develop as an economy and as a capital market, and I think that there is definitely a positive perception of India as an investment destination for foreign investors. I think when you think about the big economies around the world, I think it's probably pretty consensus that India has the most untapped potential. Given the size of the population, given the quality of the institutions and the education levels, that there's huge opportunity for infrastructure investment and increases in manufacturing and moving from sort of over the next decade or two lower sort of value manufacturing to high value. So there's huge opportunities. I think that is probably a consensus view with most institutional investors around the world. I would say that people probably still need to be convinced of some of the catalysts. So seeing some of the reforms come through, start to see some of the expected implementation of the infrastructure spending. So that would be my kind of assessment. I think I can't speak to some of the foreign direct investment, but obviously Amazon has been putting a lot of money into India. So I think you're going to see some of those bigger tech. Consumer-oriented businesses probably continue to invest as well, as it's a very attractive population to be providing goods and services to.
Looking at the global market setup, we all know that the US markets are at record high. Several global indices are also surging in the same way. But at the same time, beneath all of that euphoria, there's some amount of nervousness that global markets have not seen a decent correction for some time now. Could it be triggered by geopolitical issues, or perhaps something to do with the commentary from Mr. Trump? Do you think there is this risk, and if yes, how are you analyzing it?
Yeah, I think it's a good question. I think I would separate out the geopolitical risks to the let's call them market-based risks. And so, the geopolitical risks are always present in one form or another, and generally when these risks flare up, the market tends to overreact as the probabilities of these events are hard to estimate. They tend to be relatively low probability, but because they're very salient, they're very people can imagine how bad could get, and that tends to have a negative effect on asset prices. So we tend to avoid the guessing game on the geopolitical stuff and look at history and valuations, and so we tend to think the markets overreact to those types of things, but we're far from experts on sort of predicting those. But the bigger risks that we see within markets, certainly for long-term investors, is the fact that in places like the United States, as you point out, stock prices are very high. Cash flows are actually very high relative to history. So when you look at profit margins, when you look at return on equity, when you look at free cash flows, when you look at the amount that's been returned to shareholders through buybacks, it's all very high relative to history. At the same time, we have very high PE ratios, and so very low implied discount rates on markets. And when you think about where interest rates are, very low, cash rates very low, that means that people are willing to pay more for a given level of cash flows, which is not necessarily an irrational thing to do, but it assumes that the current conditions remain in place for the next decade or two, which we don't think is necessarily a sensible assumption. So we think if you have an economic recession, earnings are likely to fall, investors are likely to sell stocks, discount rates are likely to rise, and valuations are more likely to move back to a reasonable level. And so we think over the next 5 to 10 years that's a reasonably likely scenario. And so therefore we are owning more lower risk investments, so cash and high grade bonds, and we're more defensively positioned within our stock portfolios who are underweight US stocks, which we consider to be relatively overpriced versus history and also versus other markets. And then we're selective in developed markets, so we think certain sectors in Europe look attractive, like European financials, European energy, certainly energy is more attractive now, and then selective telecom markets around Europe, and then emerging markets we still think look reasonable, although not as attractive as they were at the beginning of 2016. So I'd say our portfolios are defensively positioned for that risk of falling valuations and declining corporate profits. And right now we think you're not being necessarily compensated for taking a lot of risk, and so therefore we think it's sensible to be a bit more defensive. Timing's always very unpredictable, so we don't try to time things. We just accept that if we've got a lot of cash and the markets turn south, then we can be aggressive buyers when other people are aggressive sellers, and generally that tends to work out well over the long term.
All right, Daniel, on that note, we'll say thank you. Thanks a bunch for taking time out for us. Daniel Needham, CIO of Morningstar Investment, talking exclusively here to us on ET Now. With that, we'll wrap things up in this edition of Smart Markets, leave you with cues for tomorrow's trade. Thanks for watching.